Did you know a recent survey revealed that 61% of Americans own stock? That's more than half the country tapping into the power of the stock market. And well, let me tell you, there's a strategy that's not just for the Wall Street experts, but for anyone who wants a slice of the financial freedom pie. Dollar cost averaging. It sounds like something out of an economics textbook, but trust me, it's simpler than you think and incredibly effective. So in today's video, we'll explore how using dollar cost averaging can become your stealthy ally in the ever-fluctuating stock market. But is a consistent methodical investment approach more effective than trying to time the market for quick gains? Without further ado, let's find out. Dave Ramsey isn't just a radio voice you hear while driving. He's a financial wizard who turned his life into a success story we all secretly envy. He went from zero to hero, crafting a seven-figure net worth and bagging a cool $250,000 a year before hitting 30. Impressive, right? But Dave's big on a little thing called dollar cost averaging. It sounds fancy, but it's actually pretty straightforward. Let's break it down, shall we? Let's say you're at a carnival trying to hit the bullseye in a game of darts. You could throw all your darts at once, hoping to hit the target, or you could play it smart, throw them one by one, increasing your chances of scoring. That's dollar cost averaging in a nutshell. It's all about consistently investing your money in bits, whether the market's soaring high or dipping low. Why does this matter? Well, let's be real. Who wouldn't want to invest at the lowest point and sell at the peak? But here's a reality check. Timing the market is like trying to catch lightning in a bottle. It's pretty much a myth. So what do smart investors do? Enter dollar cost averaging. It's like setting your investments on autopilot. Say you get your paycheck every 2 weeks. Instead of splurging on things you'll forget next month, you funnel a fixed slice of that cash into your investments. Regular, steady, no fuss. And here's the best part. This strategy smooths out your investment journey. Sure, it's like a roller coaster ride with ups and downs, but you're not just throwing all your chips in at once and hoping for the best. You're playing it smart, investing through thick and thin. And while you might not hit the jackpot, you're also dodging those gut-wrenching drops. It's all about cruising along steadily, aiming for that sweet spot, the average market return. There are two ways to do it: buying everything in one go, that's lump sum investing, or picking up a few items each time you visit the store, that's dollar cost averaging. Now, if you buy all your snacks at once and prices suddenly drop the next week, you'll probably kick yourself for not waiting, right? That's the risk with lump sum investing. If the market takes a nosedive right after you invest a big chunk of money, your wallet's going to feel it.
And you have the benefit of going, oh, when the market's down, I'm not panicked because I'm kind of excited. I'm actually buying shares. I'm buying into the mutual fund at that point. When the market's up, you're like, it's up. So my account looks really good, but I'm not buying as many shares.
Here's where dollar cost averaging shines. It's like spreading your snack shopping over several weeks. Some days the prices might be high, some days they might be low, but over time you're likely to hit a sweet spot. By investing a fixed amount regularly, say every month, you buy more when prices are low and less when they're high. It's a bit like averaging out the cost of your snacks over time. What's great about this? Well, it takes the guesswork and emotional roller coaster out of investing. No more biting your nails trying to time the market perfectly. With dollar cost averaging, you're playing a steady, long game. You're not trying to leap in at the perfect moment. Instead, you're smoothing out your investment path, which can lead to a more comfortable and potentially more profitable journey. And here's the best part. You can use dollar cost averaging with pretty much any investment: stocks, mutual funds, ETFs, and even the roller coaster world of cryptocurrency. It's a versatile strategy that suits various investment appetites. Now, let's look at an example.
Is that you buy shares at this month, and then if the market goes down, you buy more shares with the same amount of money the next month, and then the next month it goes up a little bit. Well, those shares have all gone up then. And so you're buying some cheap shares when the market cycles, and you're buying some expensive shares when the market cycles. And the dollar cost averaging of that creates a very cool effect mathematically that causes you to end up with really good money, a really good return on your money.
Imagine you're in Sarah's shoes, an everyday investor looking to dip her toes into the stock market. Sarah's got a plan: invest $100 every month into a specific stock. She could do this manually, picking a day each month to invest, or set up an automated plan with her brokerage where the money gets invested on the first day of each month without her lifting a finger. January rolls around and Sarah kicks off her investment journey. The stock is priced at a neat $10 per share. With her $100, Sarah snaps up 10 shares. Simple start, right? But hold on, February brings a twist. The market dips, and now those same shares are $8 apiece. Does Sarah panic? Nope. She buys 12.5 shares this time. More bang for her buck with the lower price. March comes with a spring and a slight rise in stock prices to $9 per share. Sticking to her plan, Sarah invests another $100 and gets 11.1 shares. Notice how the game's changing? The market's doing its usual dance of ups and downs, but Sarah's playing it cool. Now, let's crunch some numbers. Over these 3 months, Sarah's put in $300, but she doesn't just own 30 shares, which would have been the case if she dumped $300 in one go when the stock was $10. Instead, she's got 33.6 shares in her pocket. The average cost per share she has paid? About $8.92. That's lower than her starting point. So what's happening here? By investing a fixed amount regularly, Sarah's buying more shares when prices are low and fewer when they're high. She's not just riding out the market's mood swings, she's leveraging them. This is dollar cost averaging at its finest. A steady, disciplined approach that smooths out the investment journey, especially in a market that can't sit still. First off, DCA makes investing almost like a set-it-and-forget-it kind of deal. You decide how much you want to invest regularly, and then, like clockwork, you make your investment, come rain or shine in the market. This automation takes a massive load off your shoulders. No more trying to guess the best time to buy. Timing the market? That's old news with dollar cost averaging. Now, let's talk about emotions.
Cost averaging is the emotional advantage. Because as the market comes up or the market goes down, you don't feel like you've got all your chips slid to the middle of the table betting on one hand.
The stock market can be an emotional roller coaster with highs of excitement and lows of panic. DCA is like the calm friend who tells you to take a deep breath and stay the course. By investing regularly, you're not swayed by fear or greed, often the culprits behind hasty, regrettable investment decisions. Think of it as a marathon, not a sprint. Dollar cost averaging is a long-term strategy. It's not about making quick gains, it's about steadiness and consistency. While others are jumping in and out of the market, trying to chase profits or flee from losses, you're steadily investing a fixed amount. Over time, this approach can really pay off. Let's take 401k plans as a prime example. Employees contribute a set amount each pay period, regardless of the market's ups and downs. This regular investment can lead to buying more shares when prices are low and fewer when they're high, which could mean a better average price over time. But it's not just for 401ks. You can apply DCA to regular purchases of mutual funds or index funds, whether in a tax-advantaged IRA or a regular brokerage account. It's a versatile strategy that fits various investment plans. Then there is the market volatility aspect in this. Dollar cost averaging can be a buffer against this. By spreading your purchases over time, you're not putting all your eggs in one basket at a single market price. This can lead to a smoother investment experience, reducing the impact of market swings on your portfolio. So you're curious, who should jump on the dollar cost averaging bandwagon, right? Picture DCA as a trusty, reliable car. It's not the flashy sports car that zooms past you on the highway, but it's dependable, safe, and gets you where you need to go without the drama. First up, let's talk about the newbies in the investment world. If you're just starting out, DCA is like your best bud. It's there to take the guesswork out of investing. Instead of trying to hit the market at its highs and lows, which, let's be real, can feel like trying to catch a greased pig, DCA allows you to invest a fixed amount regularly. It's like putting your investments on autopilot. You're investing without the stress of playing the market timing game, which can be a massive relief for beginners. Now, what about the long-term investors? Those folks who are in it for the long haul but don't have the time or interest to watch the market like a hawk, DCA is perfect for them too. It's like having a slow cooker in the kitchen. You set it up, go about your day, and come back to find a delicious meal ready. Similarly, with DCA, you set up your regular investments and let them cook. You're building your financial future without having to hover over it constantly. But here's the catch: DCA isn't the magic solution for everyone. DCA might not be the best strategy if the market is on a steady uphill climb or a consistent downhill slide. It's like having an all-terrain vehicle when all you're doing is driving on smooth city roads. Sure, it works, but it might not be the most efficient choice. So when you're considering diving into DCA, consider your investment style, goals, and what the market is doing. It's all about finding the right fit for your financial journey. As we wrap up, how will you use the power of dollar-cost averaging to chart your course toward a more secure financial future? We'd love to hear your thoughts. Thanks for watching.